Welcome back to the Deep Dive. Today is Tuesday, February 3rd, 2026.
It's good to be back.
If you've been following the Malaysian market or, just following the show, there's one giant we have been tracking for, the last 18 months or so. We are talking about Sunway REIT.
We are. This has been a bit of a saga for us, hasn't it? We started looking at them really closely back in late 2024.
Right when they hit that RM 10 billion asset under management milestone.
Yeah, exactly. And then we checked in again all through 2025 as they started, buying up malls and factories left and right.
We did. We've watched them evolve from what I used to call a sleepy, reliable landlord into something much more aggressive. And we've been asking the same question for the last 3 deep dives. Can they actually pull off this transition from just holding assets to, actively managing and recycling them?
That's the whole active manager thesis we've been testing. And today, we don't have to guess anymore. We've got the report card.
We do. We're looking at the Q4 and full financial year 2025 results, and we've also got a fresh research note from Kenanga Research that just dropped.
And the numbers are pretty telling.
Oh, they're loud. We're talking record-breaking distributions, massive cash injections, and a strategy that's really, really taking shape. But before we get into the weeds of this, just a quick request from us. If you're getting value from these deep dives and you want to support what we do, please take a second to click like and make sure you're subscribed to the Night Eyes YouTube channel.
It really does help us keep the lights on and lets us track these stories for you over the long term.
It does. So, shall we open the books?
Let's do it.
Okay, let's start with the number that every unit holder cares about the most, the payout. For the full financial year 2025, Sunway REIT declared a total distribution per unit or DPU of 14.48 sen.
Which is a massive number. I mean, to give you some context, if you go back to FY 2024, the DPU was 10 sen.
Just 10 sen.
So year over year, unit holders are seeing a nearly 45% increase in their distribution. That's not a small bump. That's a leap.
It's huge. And if we looked at the top line, revenue for the full year came in at RM 894.3 million. That's up almost 17% compared to last year.
And the net property income, or NPI, rose about 15.5% to RM 658 million.
So just to be clear, the NPI is basically their profit from rent, right?
Yeah.
Before all the other corporate stuff.
Exactly. It's the core profitability of the actual buildings. And seeing that grow by double digits, specifically 15.5%, tells you the core business is very healthy. They're keeping about 73 cents of profit for every ringgit of rent they collect.
That sounds great. And there's always when you dig into these reports, I was looking at the Q4 specifics, just the last 3 months.
Okay.
Revenue was up a little bit, but I looked at the services segment and it was zero. Literally zero revenue. They just stopped doing business there.
Okay. This is the smoking gun of their strategy shift. And it's something we actually predicted in the last deep dive.
Right. The services segment was basically the rental income from the Sunway University and college campus. The reason that line item hit zero in Q4 is simple. As of September 30, 2025, they don't own it anymore.
The big disposal. I remember.
Correct. They completed the sale. So, of course, the rental income stopped coming in during that last quarter. That explains the dip on that one line. But you have to look at the other side of the ledger. Look at the realized profit for the year.
I see it here. Realized profit attributable to unit holders jumped 31.2% to RM 451.2 million.
And that surge is the accounting gain from selling the university. This is the definition of asset recycling. They traded a mature, low-growth asset in the university for a massive lump sum of cash.
Okay, so they sold the family silver. The big question is, what do they do with the money? Did they go on a spending spree?
This is where management really earns their paycheck. They didn't just burn the cash.
Yeah.
If you look at the balance sheet, total borrowings actually decreased. By RM 269.2 million in the fourth quarter. They took a big chunk of that university money and paid down their debt. Wow. That seems incredibly prudent, given that interest rates aren't exactly zero anymore.
It is textbook capital management. By paying down debt, they lower their gearing ratio back down to the low 40% range. This creates what we call debt headroom.
Meaning they can borrow more if they need to?
It means if a massive opportunity comes along next month, they have the credit capacity to borrow another, say, RM 300 million or so without scaring anyone off.
So they cleaned up the balance sheet, but let's talk about where the growth is actually coming from now, because you can't sell a university every year to boost profits.
Right, you need rent.
And looking at this report, the engine room seems to be retail.
Engine room is an understatement. Retail is the entire propulsion system right now. Retail NPI surged 28.7% for the full year.
That is nearly 30% growth in their biggest segment. That's staggering for a REIT of this size.
It completely validates the aggressive acquisition spree we covered. Remember, all through 2025, they were buying everything.
Hypermarkets, the malls.
Exactly. This growth includes full contributions from those 6 Sunway REIT hypermarkets, plus Sunway 163 Mall, which they picked up in October, and the Klong Mall in December.
And the Aeon Mall Seri Manjung in July. It felt like they were announcing a new deal every 8 weeks last year.
They were. But I'd argue the most impressive part here isn't even the new malls. It's what they did with the old ones, the asset enhancement initiatives, the AEIs.
You mean the renovations?
Exactly. The Sunway Pyramid Oasis Wing reopened in late 2024, and the Sunway Carnival Mall refurbishment finished up in May 2025. In our last deep dive, we talked about that data showing foot traffic at Pyramid jumped 40% after the revamp.
That 40% number stuck with me. But does foot traffic actually pay the bills? Or is it just people window shopping?
Indirectly, it absolutely pays the bills. More bodies mean higher sales for the tenants. When tenant sales go up, Sunway REIT can demand higher base rents, or they take a bigger cut of the turnover rent, which is a percentage of sales.
So that 28.7% MPI jump is the proof.
It's the financial proof that the renovation money wasn't just wasted on fancy tiles. It translated directly to the bottom line.
So retail is booming. But I noticed another segment that's putting up some absurd percentages, even if the total amount is smaller. Industrial and others.
Yes, the rocket ship, as we've called it. NPI for industrial rose 52.1% year-on-year.
Over 50% growth.
Now, you have to be careful with the law of small numbers. It's growing from a smaller base than retail, but it is significant. This is driven by the new Sunway REIT industrial asset in Pier and better occupancy at their Petaling Jaya site.
This is their hedge then. If e-commerce eventually hurts the malls, they own the warehouses too.
That's the logic. It's diversification. Malls depend on consumer sentiment. Industrial depends on supply chains and logistics. It helps stabilize the portfolio.
But not everything is stabilizing. We have to look at the ugly parts of the report. The office segment. It seems to be bleeding. NPI declined 8.1% for the year.
The office segment is definitely the drag on the portfolio. Occupancy slipped to 82% because they lost a tenant at Wisma Sunway.
Yeah.
But honestly, this isn't entirely Sunway's fault.
You're letting them off the hook.
I'm looking at the macro picture. The Klang Valley has a massive oversupply of office space. It is a tenant's market. Landlords are slashing rents just to keep the lights on.
So even Sunway's ecosystem can't protect them from that.
It's not immune, no. It's a very tough market. And unlike the university, which they could sell for a massive profit, selling distressed office towers in an oversupplied market is very, very difficult. They might be stuck with this for a while.
In the hotels?
Hotels are a mixed bag, but it's a recovery story. Occupancy hit 65% in Q4, up from 50% in the first half of the year.
65% doesn't sound spectacular for the peak holiday season.
It's decent, but not great.
Yeah.
It was driven by the holidays and the return of MOC events, the big conferences and exhibitions.
Yeah.
But hospitality is volatile. It's a high-risk, high-reward segment.
So we have retail on fire, industrial skyrocketing, hotels recovering, and offices dragging. I want to circle back to the strategy. We know they sold the university, but looking at the pipeline, they aren't done building.
No, the capital recycling continues. They're taking that money and dumping it into 2 major projects. First, their Sunway Pier.
Right, the redevelopment.
They're turning it into a retail-centric tourist attraction.
That has a hefty price tag, RM $462 million. And the timeline says completion isn't until the second half of 2028. That's a long time to have capital tied up.
That is development risk. And remember, they're also spending RM $140 million to build a hotel on top of Sunway Carnival Mall. That's due in Q4 2027.
Building a hotel on a mall, that sounds like doubling down on the ecosystem strategy.
It's exactly that. And notice the pattern. They're selling the standalone Sunway Hotel Seberang Jaya to build this new integrated asset. They want everything connected. They want that synergy.
This brings us perfectly to our financial Moat scorecard. Last time, in Q3, we gave Sunway REIT an 8 out of 10. Given the record profits, but also the dragging office sector, does the score change?
I've reviewed our criteria based on these Q4 results, and I think the 8 out of 10 stands firm. It's a very solid 8.
Okay, walk us through the pillars. Why does it hold up?
Let's look at Pillar 1, the integrated ecosystem. I give this a 9 out of 10. This is their superpower. Sunway Pyramid isn't just a mall, it's a city. You have the hotel, the theme park, the hospital, all connected.
A competitor can't just replicate that.
They can't. It creates a captive audience. Pillar 2 is financial health. That gets an 8 out of 10, largely thanks to the debt repayment. Their gearing is safe. They have headroom to borrow, and they've locked in fixed rates for a good portion of their debt.
Smart. And pillar 3?
Proactive management. I give this a 7 out of 10. The foot traffic jump at Pyramid and the successful pivot to industrial proves management knows what they are doing. They are not sleeping at the wheel.
So why not a perfect 10? What's keeping them from being invincible?
External vulnerabilities. A 10 out of 10 Moat would be bulletproof. Sunway REIT is not. They are heavily exposed to consumer spending. And as we discussed, they have that office anchor dragging behind the boat. They are strong, but they are not immune to the broader economy.
Speaking of the broader economy, let's pivot to the analyst commentary. We have the Kenanga research note here, and I have to say, this confused me a little.
Okay.
Sunway just posted record profits, but Kenanga has an underperform call on the stock. What's that about?
This is a classic case of needing to read the fine print. In the world of REITs, underperform doesn't always mean the business is bad. It often just means the stock is expensive.
Expensive relative to the dividend yield.
Exactly. Kenanga estimates the net dividend yield for Sunway REIT is around 4.5% at the current share price. For a Malaysian REIT, that's on the lower side. You can get 5.5% or 6% elsewhere.
So investors have bid the price up because they love the growth story.
Which compresses the yield. Kenanga is basically saying, great company, great results, but if you're an investor looking for pure income, you can get a better return for your money somewhere else.
But they did raise their target price, didn't they?
They did, up to RM 2.28 from RM 2.22. So they believe the value of the company is increasing. They just don't think it's a bargain for yield seekers right now.
Did Kenanga highlight any specific risks for 2026?
Yes, and these are important. Management cited disruptive tariff barriers by the U.S. as a major macro risk.
A polite way of saying trade war.
It absolutely is. If trade slows down, people have less money to spend at the mall.
And Kenanga also mentioned subsidy rationalization.
The government cutting fuel subsidies.
Yeah.
That's the biggest immediate threat to retail. If petrol prices go up, everyone's disposable income goes down.
So less money for Uniqlo.
Less money for Uniqlo. And of course, competition is always there. Airbnb chipping at hotels, the office oversupply. Those aren't going away.
Okay, so looking ahead, management says they are cautiously optimistic. The U.S. Fed might cut rates, but Bank Negara Malaysia is expected to hold steady.
That's the consensus. Stability is the baseline. They aren't predicting a boom, but they aren't predicting a recession either.
So, bringing this all together, it feels like Sunway REIT has successfully completed a metamorphosis. They used to be a passive landlord. Now they are active capital allocators, selling universities, buying malls, building piers, paying down debt.
That is the key takeaway. They are constantly asking, is this money working hard enough here, or should we move it there? And the Q4 results show that, so far, they are getting the answers right.
The Sunway ecosystem remains their superpower. But here's a final thought I want to leave you with, and it's something for you, our listeners, to really chew on.
Let's hear it.
They sold the university. That was a defensive, recession-proof asset. Students go to school whether the economy is good or bad. In exchange, they are doubling down on malls, hotels, and tourism assets that rely entirely on people having extra money to spend.
That is a very sharp observation. You're asking if they are becoming less diversified and more of a pure consumption play.
Exactly. They are moving up the risk curve. If we hit a recession, people stop shopping and traveling, but they don't stop studying. Sunway REIT is arguably riskier today than it was 2 years ago. The question is, with the yield lower than its peers, is the premium price you pay for Sunway REIT worth that active management safety net? Or are you paying extra for a portfolio that is actually more vulnerable to a downturn?
That is the multi-billion ringgit question, and it's one every investor needs to answer for themselves.
We'll let you decide on that one. Thank you so much for listening to this deep dive. We hope this breakdown helps you navigate the complex world of Malaysian REITs.
It's been a pleasure.
And please, if you found this valuable, we'd really appreciate it if you clicked like on this video, leave a comment with your thoughts. Do you think the pivot to consumption is smart? And don't forget to subscribe to the Night Eyes YouTube channel so you don't miss our next update. We'll catch you on the next deep dive.